Joining us right now, the professor, Jeremy Siegel, professor emeritus of finance at the University of Pennsylvania's Wharton School of Business, also chief economist at WisdomTree. How do you even begin to think about where we are in maybe what we're calling an excursion or maybe a war in the Middle East and what it's ultimately going to mean for the markets right now, Professor?
Yeah, let me speak to the inflation first and maybe Fed cuts, which we were just talking about. First of all, I think the data at 8:30, we're going to get in an hour and a half, is going to be pretty good. I think, in fact, a couple of the numbers may come in below expectations. Secondly, we should note, and I think Steve did, that the Fed pays more attention to the core rate. Now, we define core rates of inflation as excluding food and energy. Now, there is some bleed through, obviously, into other sectors, but they've long recognized that the volatility of those two sectors and energy shouldn't be a major factor in setting rates. And the third is, I know that Joe just mentioned, we don't have that tailwind of lower oil prices that we had, but we even have a stronger tailwind, and that is shelter prices have really slowed down. Rents virtually unchanged on a national level for 3 years. The Case-Shiller home price index up between 1% and 2%, which is the lowest it's been for many, many years. That's a big component both of the core index and the CPI. Now, many things can happen, but I do think that the Fed has room to cut. Maybe not any cuts until Warsh takes over for the June meeting. And, of course, a lot of things can happen between now and the middle of the year.
When you think, though, about the ability to get those cuts, Kevin I don't know how many you think Kevin will want, but trying to get the rest of the board on board, if you will.
Well, it depends on what is happening, and I mean, June seems like years away, given all the news that we've been buffeting every hour. We make a statement, and oh my goodness, it changes. I mean, clearly, if the oil market, if Hormuz stays closed for a long time, and we go up 120, 130, 140, 150, that's going to really reorder a lot of things. By the way, one favorable factor that a few people have talked about, and that's one, and it's a consequence of us being basically energy independent, is that the dollar has risen. And what that means is our imported goods are less expensive than they would have been otherwise. So that is going to help on inflation. What hurts on the oil side gets helped on the import side. Now, of course, that's also impacted by tariffs and what rate we put on those. But anything else equal, higher dollar is lower imports, and I think that does offset the inflation. So, I mean, a lot of things can happen, and this war certainly is something where has greatly increased uncertainty.
Right. So, Professor, look, here's the thing. For many, many years, I would say the last 3 or 4 decades, you'd hear of some kind of skirmish in the Middle East or something worse even than a skirmish, and it would turn out to be a great buying opportunity. And as a result, you did not have the market sort of wobble as much as they used to, because we sort of got used to this idea that there was either a put on the market or that things just ended well. Is that still, you think, the prevailing view, or do you think this time is different?
Well, there's two things that are very different. One is energy self-sufficiency that we didn't have, when the oil hikes hit in the 80s, 70s and 80s, and we were importing most of our oil from OPEC in the Middle East. And thank goodness we don't have to do that anymore. A second factor is the energy intensity of our economy and how much energy we need to produce for $1 of GDP has gone way down. By the way, more than 50% because of energy efficiencies and movement in the service economy. We also noticed that the big oil spike that resulted from the Russian invasion of Ukraine did not cause a U.S. or a worldwide recession, and that was the first oil spike that really did not cause a slowdown. So there are a lot of good economic reasons why we are more insulated today than we certainly were in the past to the type of price increases that we see as a result of the Mideast situation.
Hey, Jeremy, I agree with all of that. This is not going to be the same as an oil spike that we probably saw in the 70s. But even with our energy dependence that we have these days, we're not completely insulated. We have to import all kinds of refined products, jet fuel. I think it's more than 200,000 barrels a day. You can run down for diesel and distillate products that we're importing because we don't have the refining capacity. And so many of the things that we need, that we do import, are going to be higher priced potentially as a result if this goes on. How do you kind of game out when and where we'd feel the pinch, obviously understanding we're in a much better position than countries in Europe or in Asia?
Yeah, we are in much better position. And of course, and you're perfectly right, just because we're energy independent doesn't mean that for oil, all the refined products and everything. We are a big exporter of natural gas, importer of some of the things that you just mentioned, which certainly going to hurt the consumer. There's no question about that. Many of the economists have been looking at that, and just let's say if gasoline is 50, 60 cents higher, and it's almost there now, that could take 1 to 2 tenths off, 3 tenths off of GDP. Going up $2 higher could take 8 to 1 percentage point off of GDP. So certainly there would be an impact. I'm not going to deny that, and certainly we should know there will be a political impact because we know in 7 or 8 months we have the midterms coming up, and energy prices, particularly gasoline prices, are one of the things that people keep right in mind, if anything else. So there's a lot of moving parts here that are very, very undecided at this point. I mean, I was very anxious Friday and I said if it goes above 200, we're going to have a problem. Well, it did, and then came down when, I think Trump being very sensitive to it. I mean, it said, okay, we're near the end, but what is that end? Everyone here on the program said, are we able to go through the Straits of Hormuz, where 20% of all oil goes through, as well as many other fertilizer and petroleum products? I mean, that's a $64 question, which I think no one at this point has an answer to.